Okay, I'm going to start with what is a very simple concept, and this is that investing in just two or three truly great stocks in your lifetime can be game changing for your portfolio. I talk about this when we do seminars across the country, when we do our 3-hour in-depth webinars, as well as one of the core concepts that we use. This may sound kind of like hyperbole. In fact, you will find that it's not hyperbole, and you'll find that many of the great stocks and the returns that they produce are from some of the most mundane businesses, but they are great businesses. And I'll use some real world examples of that as we go forward here. Unfortunately, you don't hear this concept from most financial advisors. And even more unfortunately, the traditional construction of Canadian portfolios inhibits you from creating true wealth based on great individual stocks in your portfolio. However, you can make simple changes to the structure of your portfolio to capitalize on great stocks over the long term. This is what we talk about in our webinars and when I give talks across the country every year. But don't take my word for it. In fact, this past year, Warren Buffett, perhaps the greatest investor of all time, stated that in his 58 years of Berkshire management, his satisfactory results, and we all know they've been far better than satisfactory, have been the product of about a dozen truly good decisions. That's one about every 5 years. So let that sink in. What he's saying is that only 12 great investments in stocks in his almost 100 years on this earth have made him one of the richest humans on the planet. It does not take many, and perhaps more importantly, they do not have to be complicated moonshot businesses that promise to change the world. Often they are the most boring, mundane businesses that you can imagine. Buffett, some of his greatest wins include Coca-Cola, a seller of soda pop, Bank of America, and American Express, all return tens of thousands of percent. They are a reminder of this. Boring businesses produce astonishing returns with less risk. I like to give real world examples, and this is a real world example we gave at a recent speech. You can see here, these are the type of boring businesses from our research today. Here are 5 actual keystone recommendations that have changed the fortunes of our client portfolios. Now, I put these returns up because they make us look smart. Quite frankly, Aaron, who's not here, like I said today, he really needs that. No, really, actually, the real reason I put these up is because these are the great stocks that we have recommended and invested in. And it's kind of to dispel the myth that you have to take on undue risk and make bets on speculative moonshot type businesses that promise to change the world in order to create true wealth in your portfolio. Most businesses, most often, these are just profitable, boring businesses that produce these astonishing returns. Let's look at these individual companies. Boyd, what do? They own automobile repair shops. They fix cars. Hammond Power, they've been around for 100+ years. They make electrical transformers. Boring, basic businesses. Expel, they sell automobile paint protection film. Water Furnace makes geothermal heating and cooling systems for homes. Not sexy, but you can see the returns here. Now, let me give you some real world numbers to put this in perspective of how it can change the value of your portfolio. I'm going to give you an example portfolio here, a nice round number. We're going to say this portfolio is $500,000. You're going to buy 20 stocks. We believe in starting off with an equal weighting on those stocks. So you take 500,000, divide by 20, you get 25,000 in each. So equally weighted. At the recommendation prices, this shows the impact of 1 or 2 truly great stocks can have on your portfolio in the lifetime. You can see here, if you would have bought Boyd as one of your 20 stocks, 25,000 invested in it today, worth 3.18 million. $25,000, one of 20 stocks, today's value on Hammond Power, 6.2 million. Game-changing returns from just 2 stocks in a portfolio, and really could have changed the wealth of your family over the last 2 decades if you had invested in those companies. So your next question may become, it's either how can you find the next Expel, Boyd, Hammond Power, Jana Systems, or Water Furnace in your portfolio? What do these great businesses have in common? Or number two, how do you construct a portfolio to capitalize on these great, truly great stocks? Well, next week, I'm going to discuss number two, or how many stocks, not shocks, how many stocks you should own in your portfolio. That's all I got for this week, but we'll get to that second item there next week. Any comments, or should we move on?
Oh, I mean, I've sat through that presentation many, many times before during all of our, or many of our seminars. That
just glazed over there? You just became a glazed donut? You forgot what was going on?
Yeah, I was snoozing. Felt like I was still on my bachelorette party. Just kidding. But no, I think that it is, truly important to hear. And I mean, if you did go to finance school, you would have heard, kind of like exactly how many stocks to hold. But even in university, I feel like, again, they, kind of lean towards the what we would term it diversification. Again, I'll let Ryan get into that next week. But just kind of like,
yeah, it's the financial planners model that really designed by big corporations, big banks, essentially, that has you investing in those banks, mutual funds. They get paid more for putting you in those funds. And like Brett said, the fees on the mutual funds that you're putting you on versus the ETFs are higher. Often, instead of buying just 3, you're buying 10 to 20. We've seen many portfolios that come to us with, with ETFs, or even, just mutual funds that own 150, 200 stocks, and they have 10 of them. We'll show next week that, you can make a significantly diversified portfolio with, 20 to 25 stocks, but you've literally bought hundreds of stocks. So you're buying the market 2, 3, 4 times over. So that means you're going to get the market return, and you're going to underperform due to those fees. Makes the banks and large financial firms a lot of money. It has you underperforming the markets over the long term. You literally can't outperform the markets because you are the markets, and then you get charged more for that type of arrangement. It's kind of the what we try to work against, and we're trying to have a low cost way of building that portfolio, concentrating on good solid stocks, building that out over time. And next week I'll tell you how many stocks we think that you should buy, and we'll get into what types of stocks that we think you should buy in your portfolio as well in the coming weeks. So
or go on, Brett. Go on.
I was just going to say the one thing which, like, our methodology is really only possible in the last 20 years because direct investing really wasn't a thing prior to that. Now you have access to cheap, even in Canada, relatively cheap compared to, like, if you go to a big bank right now, it'll be $10 as a stock trade, which is still very expensive. But then if you look in their fee schedule, it'll be $35, $40, $50 to use a telephone trading platform, which is what you had to do before. So it's just become more accessible. So you don't need to use those ETFs if you don't want to. It's not something you need to do, because before, if you're paying $50 a trade, obviously, unless you have hundreds of $1,000s to invest in each thing, that can eat away quite quick. You're paying more than your 1-2%, which was their selling point at the time for mutual funds in the 70s, 80s, and 90s. That's why you did it, because it was easy, it was simple. But now you have a simple way to invest directly into companies on your phone. If you want to be super cheap, go download Wealthsimple. There's $0 trading. There you go. And those fees are disappeared, and you can recreate. You could technically, if you really wanted to, you can even recreate an ETF for cheaper. Like it's getting that absurd these days.
Yeah. Like, and I've had like quite a few conversations with like new clients who will sign up. They'll want me to quickly take a look at their portfolio and be like, can you like tell me what my advisor has me in, and we'll go through, and it'll take some time. But, in many cases, all of a sudden they're holding, 200 to, 400 stocks, and even the ETFs, like there is some overlap between, the ETFs, where all of a sudden the highest position in this one ETF and this one mutual fund, they're maybe doubled up on a specific company. And I mean, if it's a good company, that's fine to be, a little bit overweight on. But again, just, the advisors placing them into these, mutual funds, and they haven't even really looked into, the fund facts of, either the ETF or mutual fund to really know what it is invested in, other than just, the name of it.
Yeah. And the point is, like, our clients are coming to us typically not to just mirror the market. They want to try to create wealth, build it over time. So if you do that and you build it in a traditional methodology, you own hundreds of stocks through ETFs, mutual funds. If you have a Boyd, if you have a Hammond Power, if you have a Jana or Water Furnace or any Expel, any one of these companies that has gained thousands of percent that we've recommended over time, if it's one of hundreds of stocks you own in your portfolio, it's fine. It helps a little bit. But if it's one of 20 stocks you own in your portfolio, it, like we showed there, just even in a $500,000 portfolio, it literally changes your financial future over a 10 to 20-year period. Like, it changes the outlook of your entire family's finances over that time. And that's where, you can create true wealth in your portfolio. Warren Buffett, doesn't own 500 businesses, right? Like, because then they start to become a smaller needle mover in his portfolio and the overall portfolio of Berkshire Hathaway. Now, like, or his portfolio individually, there's been studies on it, and like, it's about 78% were in 8 individual stocks. Now, we're not advising to do that. I mean, that is Warren Buffett doing that. But if you want to create wealth, again, we'll talk next week. Not 2 to 3 stocks, not 50, 100 stocks, but there's a sweet spot in there that you can hold a simple amount of stocks that is easy to do through one of the discount brokerages. It doesn't cost you a lot, and you can get to know those businesses, or you can have us get to know those businesses for you and just, buy the companies when we send off a buy recommendation. But you can get to know those businesses. If you own hundreds of them, you don't really know what you own in your portfolio. And like when Brennan's saying people send in their portfolios to us, they don't know what they own. If there's hundreds of stocks in there, even, we see some people owning 80 individual stocks plus, and then plus 10 mutual funds. They're just compounding on top of each other. And of course, within that, you're paying the mutual fund fees, but you're paying the advisor 1% to 2% on top of all that. When you have hundreds of stocks, you've just got the market return. You can't best the market once you get to a certain point, because every stock, you've just become the market. You're a proxy for the market, and then you're getting charged for that. It's quite disgusting, to be honest, that an advisor creates a portfolio that's over diversified like that and then charges a fee for it.
Yeah, whenever you hear the term passive investment or index investing, anything like that, you should not be paying anything really for it. You should be paying 10 to 30 basis points for the product, and that's really normally just their trading fees and some very, very basic management from them. And that's what it should cost these days. You shouldn't be paying, I very commonly see 1-2% for things that are very simple. An S&P 500 ETF, the most common ETF, you'll see SPY in the US, which is the most common. And then you'll have a mutual fund, another ETF, copying effectively the same thing, even if sometimes they don't even say they are. But once you actually look at the holdings, they're closet indexers, and they just match the index or very, very close. They might very slightly shift it, but they might add 0.1% of return in the year from whatever activity they're doing, and they're charging you 1-2% for that active management. And fund managers like that are absurd, and it puts the whole industry at really in a bad taste.
The funny thing is, like, parts of this we didn't even plan to talk to today about, but you can see it kind of grinds our gears. We talk about it in the office all the time about these fees that we see investors being charged, that ridiculous. They don't need to be fees. They don't need to be paying them, and it eats away on your retirement savings, and that bothers me, and we like to talk about it. So we talked about it a little today. We'll probably talk about it more in another segment.